following on from the positive economic developments in the Reserve Bank's quarterly bulletin yesterday, latest consumer inflation figures have provided more good news. The consumer price index rose by 5.7% last month, coming back into the Reserve Bank's 3 to 6% target range. Joining me with more is Gina Schoeman, economist at Macquarie First South Securities. Gina, thanks for coming in this afternoon.
Thanks, Aaron.
Gina, of course, we had that CPI release being brought forward to 9 o'clock this morning, and that was to coincide with the start of the Reserve Bank's two-day meeting. Do you think that the result of that CPI reading could sway the decision for the meeting?
We are not looking for a cut tomorrow. We think that instead the bank's going to take a more cautious view on inflation. Nonetheless, I'm sure their inflation expectations should soften, something we didn't see in January, which we expect to see now. Nonetheless, compared to the market, I think they're going to take a more cautious stance. The January MPC statement gave us a peek into, I would call it an unspoken fear of the Reserve Bank as to what the currency may do. We all know the currency against the dollar is overvalued at the moment. We've seen it as 15% overvalued at present. And the Reserve Bank made mention in January that they're quite worried about this wall of liquidity sitting in global equity markets. And I think they're quite worried that should this reverse, inflation will start to pick up as the rand appreciates. Nonetheless, I'm not advocating that you should make monetary policy decisions based on the fear that the currency may depreciate, but I think this is probably going to come down to their line of reasoning alongside second and third round effects in electricity, plus the fact that, remember, they cut by 500 basis points, mostly on account of growth, not inflation in the past. So looking forward, unless inflation starts to surprise hugely to the downside, and we've already got a low point of 4.5% by May, then maybe possibly post-June, we could perhaps maybe see some further loosening, but this is certainly not our base case.
Okay, so tomorrow rather is not the last chance to cut interest rates. You think there is still some scope for a cut later if events do lead to one?
I think it depends on how long the currency remains strong for, and as a result, how long inflation can sustain low levels. Not saying it'll go low, but will it start to pick up in the second half of the year, as currently people are expecting, but we may see some surprise to the downside, particularly in food. I mean, food has surprised, it's currently sitting at 1%. The question now is, will it go negative? We don't have that. We see it going to 0.5%, but staying at sub 5% levels over the course of the year. Now that's huge because it's got 25% weighting in the basket.
Of course, you said the Reserve Bank was being a bit cautious. In January, though, when they met, they didn't know the extent of Eskom's tariff hike. They have been working on a figure of 25%, which is what we actually got or will be getting. So surely that provides a little bit more certainty for the Reserve Bank moving forward.
The first round effect certainly does provide certainty. And I mean, in our view at Macquarie, we think the household impact of electricity tariffs is actually going to be even below this. We're looking at between 16 and 18%. Nonetheless, what the Reserve Bank has been going on about is the uncertain second and third round effects. So in other words, when the cost of goods and services start to increase as companies pass through high electricity tariffs, and of course the third round effects being wages compensating for this higher cost of living.
How soon before it feeds through to the second and third round effects?
Second round effects usually take between 9 to 15 months to feed through, so you'd only really see this showing up towards the beginning of next year. Third round effects should take up to 24 months. But keep in mind, South Africa is a little bit different in this regard. We've got very strong unions, so our unions don't wait to see the second round effects necessarily. They sometimes start wage bargaining simply off the first round effects without even waiting to see if the second round effects take, even if they occur.
And of course, we do know that the Reserve Bank has to look a year to a year and a half to 2 years in advance, because you have to start structuring monetary policy today to affect inflation in 2 years' time, don't you?
No, absolutely. It's all about inflation expectations and anchoring these. However, coming back to the currency on that, we find it quite interesting that the bank feeds in something very close to the spot rand into the inflation model. So if inflation had to depreciate over coming months, it would certainly move inflation expectations higher, especially from the Reserve Bank's point of view.
Well, you said you thought the rand was maybe 15% overvalued at current levels. Should the Reserve Bank be working on that figure then?
I'd like to say that they should be working some kind of forecast into their outlook, but as far as we know, they use spot where it is right now. Our view is that the rand will depreciate, not hugely, but we've got slight depreciation by the end of the year and then further out. It all hangs on portfolio investment, We've seen global appetite come back to the party. We've seen risk appetite for emerging markets quite high over recent months. If this reverses, a lot of those portfolio investments which are currently supporting the rand will reverse, and then the rand can only weaken.
And of course, we saw from the quarterly bulletin data yesterday 107 billion rand in portfolio flows coming into South Africa last year, and that really helping to cover the current account deficit that we saw in that quarterly bulletin. Do you think that we're going to continue to see that? We were chatting to Rob Tyle a little bit earlier, and he says the wall of liquidity is still there. We still do have foreign interest in emerging markets because that's where the growth is.
No, I certainly don't think it'll be completely obliterated, but there is a good chance it may slow as the world moves on to a more stable and normal path of growth, and the rest of the world starts to look maybe in diversifying out of emerging markets into the more developed world.
What did you take out of that quarterly bulletin yesterday? Of course, we saw the GDP deficit 2.8% for the full year, 4%. So slightly better than expected, but it also looked like consumers were starting to get back on their feet.
No, certainly. I think what's being thrown around today is the GDE numbers, so domestic expenditure, which bounced back mostly because of the inventory adjustment. Having said that, we're quite optimistic on the consumer. We saw some encouraging signals in the fourth quarter coming out of the details in the quarterly bulletin on not just consumer spending, but the breakdown of durable, semi-durable goods, etc. Now, we think that with real income growth climbing this year, and that's mostly thanks to some jobs being added back into the system alongside lower inflation, as we discussed, real income growth could climb to about 2%. Now this, in our view, is going to leave consumer spending quite above where the market's currently expecting. We think the consumer spending will grow by at least 2% this year.
Of course, we saw the personal debt, or household debt rather, still remaining just below 80%. Does that concern you that we haven't been paying off our debt instead of spending over the last year?
Well, it is concerning, but not if they're going to keep interest rates low at this level, as we did see debt servicing costs as a ratio of income continue to decline. As far as debt goes, well, maybe it keeps the appetite for credit at bay. On top of that, the banks don't look very willing to lend at the moment. Even though we're hearing whispers and murmurs that lending is starting to pick up, we have not yet seen any solid data on this. That said, I think it's more the cash side of the economy, cash spending, from real income growth, from slower inflation and jobs being added back, that's going to support consumer spending, at least in the first half of the year, over credit growth. So you kind of get a creditless consumer recovery coming to the party this year.